All right, everybody, welcome to Israel Keys Wealth Academy, our Saturday evening webinar this week. My name is Israel. We are continuing with our series on the introduction to market maker philosophy. So this is going to be part 3 in the series. We've done 2 parts already. The first part, we kind of defined what a market maker is, both technically but also practically, from the perspective of what we need to understand as Forex traders. We also looked a little bit at how to, well, also what they do, how they operate, why they're important to those of us who trade foreign exchange. And also we started last time, a few days ago in part 2, to look at a little bit of how to recognize market maker behavior. So let me repeat this real quick for those of you who either forgot or may have missed the first 2 sessions in this series. Foreign exchange is a $5 trillion market a day. 70% of all those transactions are controlled by 10 people, 10 organizations, or 10 entities is the word I'm looking for. If you add the next 20 biggest entities in the market, they overall will make up almost 85% of all foreign exchange transactions. The moral of the story is this: if you want to be on the right side of the market, you are better off understanding how these guys operate, what they do, how they function, and therefore how you can trade in sync with them. So we looked at a few of the rules of the market makers last time. They buy when price is dropping, they sell when price is rising, and a couple of other things. I'm not going to repeat that because of time. We're just going to go straight into today's lesson. And with that being said, I'm going to show you my chart. You're going to see it in a second. So we want to start to look at how to spot some keys to spotting the fact that a market maker has been involved in a transaction, or that a market maker has been doing something. Because like we spoke about, your job as a retail trader, successful retail trader, is to spot their behavior, spot the signs of their activity, and then ride their coattails. So just ignore what's on my screen at the moment. This is some analysis I did for a trade I took on Thursday and Friday last week. So a couple of rules. Now let's the first thing you want to understand is, if you're looking to spot market maker behavior, you see this 1 minute chart, the 5 minute chart, the 15-minute chart, the 30-minute chart, and even the 1 hour chart. Just ignore them. You will see the effects of market maker behavior in those charts, but you will not spot them, because the entities we're talking about are largely position traders. I'm just going to type this out real quick as we go along. I'm going to type in a few things so you can follow on with me. Actually, let me open a brand new chart, because I don't want to mess that analysis up. So let me open a brand new chart. Right, so properties. I like the white background. It makes allows me see clearly what's going on, but you do you. Whatever works for you is fine. Right, so just gonna write this down. Never forget this. Market makers are position traders. Market makers are position traders. What this means is they're not in the market for 20, 50 pips. You've got to understand this. When a market maker has a price objective, it is usually going to be several hundreds or even thousands of pips. You will not see that on these charts. You're going to see on the smaller time frames, the 1, 5, 15, and 30-minute time frames, what you're going to see are the ripples, the retracements and expansions, the waves that are part of larger moves. I'll give you an example. if I draw out this area here on a 30-minute chart, that looked like a significant move, right? You'd say, oh, that's a very significant move. Let's see, how many pips is that here? I intentionally pick charts that I haven't looked at before when I'm teaching these sessions, because I don't want to form fit the information. I want to show you that you can just pick up any set of charts and you will see the same principles. So that's about 100. Oh, didn't show you that. That's about 110 pips. It's 115 pips. To a retail trader, that's a huge chunk of change. But I'm going to zoom out now. And can you see that on a 4-hour chart, that is insignificant? That entire leg on a 4-hour chart was 380 pips. So like I said, that is less than a quarter, or roughly about a quarter of this entire price move. Now this price move here is 380 pips. So roughly just over a quarter. Now to make this point, I'm going to draw a bigger shape here. We're going to make it a different color. Let's see, let's make it purple. And what I'm going to do now is go back to the 30-minute chart. And you can see now that while you are in this section on a 30-minute chart, it is very easy to miss out on the big picture of what is going on. And I see this happen all the time with new traders or inexperienced traders, or even more experienced traders who are just not successful. If I get a student and I sit down with you for half an hour, if you tell me you're losing consistently or you're not being profitable, you're inconsistent with your results, I have a checklist I go through. And one of the things I'm checking is, are you tunnel visioned on lower time frames? Because even if you are trading lower time frames, if you don't have this larger picture in view, look at how far back you have to go on a 30-minute chart to get the full picture of what's happening. At any point in this chart, let's zoom out on a 30-minute chart. So there it is. That's the full picture. This is what the market maker was doing. And that's on a 4-hour chart. Because a 4-hour chart is the lowest chart that most market makers will even look at in terms of determining what they want to do. Now let's zoom out a little bit further. Let's go to a daily chart. Let's go to a daily chart now. Let's go back to, okay. So on a daily chart, that 4-hour chunk is even more insignificant. Let's put another shape. Let's put that on a, let's see now. Okay, yeah, that's the largest high there, or the highest high there. Let's put that there. Let's make this, I don't know, let's make it blue. Let's make it blue. Cool. Now, this again is roughly, let's see now, that was 380 pips. This is 1125 pips. So again, roughly a quarter. If you drop back down to that 30-hour time frame, even if you look, see this now, you can't zoom far enough on the 30-minute time frame to see the full picture of what is happening on a daily time frame. And a daily time frame is perhaps one of the most significant. In fact, you can't even zoom, you can't even scroll far back in time to see the full picture of what's happening on a daily time frame, on a 4 hour, on a 30 minute. And just for laughs, for kicks, let's do this one more time. Let's zoom to a week. Now, the vast majority of market traders are setting their objectives, long-term or final objectives, based on the weekly and the monthly time frame. Write that down, the weekly and the monthly time frame. They use the daily time frame to check things like direction, short-term turning points. They use a 4-hour time frame to see what retail traders are going to be looking at to a degree, so they can align themselves with it. But for the vast majority, they're looking at the weekly and the monthly. So let's do this on a weekly. Sorry, I'm gonna have to pick another color here, and this time let us pick. Let's see now. Let's pick. I don't know. Let's pick something funny like yellow or gold. Oh, that's ugly. I don't know if you guys can see that. That's very bright. Now, we're looking at $2,712 pips. So that's almost 3 times the daily region. It is impossible to understand what is going on at this level if you're stuck on a 30-minute or even a 1-hour time frame. The moral of the story is, when you are trying to figure out what a market maker is doing so you can be in sync, you need to start on the right side of the time frame bar. We call this top-down analysis. So I'm just going to write that out then. Give me a second. I think we got one more. Look at this. See, on a weekly time frame, we can't even see. Look at this. That orange zone from the 30-minute is not even showing. Look, I'm zooming in. This is the maximum zoom I can get, and I cannot see that orange box. Does that make sense? In essence, what you are looking at when you zoom or when you work in a 30-minute time frame or similar is invisible to a market maker. So when a market maker is planning their price action, because they use price action too, just like everybody else, they can't see your 100 pip zone or target or situation. It's like a little roach that they just crush underneath their foot and keep moving. And that's why many of you get in trouble. Because if you drop down to a 30-minute time frame, if you plan this trade, so let's assume you saw this happen, right? Let's do some. Let's assume you saw that happen there, right? On a 30-minute time frame, this could look like, okay, so look at this. So this is perfect. So you had this move here, right? Let's get rid of this. This is what a 30-minute trader would think about. You have this move here, and price came back to the spot between the 61.8 and 78.6, right? This is perfect according to price action, and then it moves again. Beautiful. And so what the retail trader would probably do is this. They put another Fibonacci there and be waiting for another trade to form in this region here. Got to get rid of that gold. It's ugly. And so they're waiting for another trade to form there. And when they see this reaction, they're excited. So they're going to put an entry here, a stop loss there, think they're going to make money, and bang, the trade stops them out. Why? Because they did not understand. See, in this case, let's see how far off you go to get this. They did not understand the bigger picture. Look at this on a daily chart. On a daily chart now, that is that zone on a daily chart. Can you see how if you were looking at a daily chart, it would be clear what was really going on. This is what's going on the daily chart. That's the controlling low in the screenshot. That's the controlling high. Prices dip below 50, so it's now at a discount. It's reacted. It's come back into that order block there. And it's reacted. So a person analyzing the daily chart would clearly see what a market maker could be looking at. If you take it a step further to go to the weekly, it's even clearer. Look, it's just crystal. Oh, no, that's still a daily. So in a weekly chart, there you go. It's a lot clear. Well, it's about the same. So in this case, you're seeing the same picture on a daily as a weekly. Same principle there. And so you need to remember, market makers are position traders. What does that mean? It means to understand their behavior. Let's get rid of this. Market makers are position traders. Put that there. Number one, top-down analysis. And so depending on what kind of trader you are, if you're a scalper, meaning you're dealing with the 5-minute charts, I would say at least start from the daily. No matter what kind of trader you are, you need to have the lowest chart you're looking at in your top-down analysis must be at the very minimum a daily chart. At the very minimum a daily chart. If you are an intraday trader, meaning you're working with the 15 minutes and maybe the 1 hour charts, you need to go up to at least a weekly chart. And if you are a swing trader, meaning you're working with the 4 hour and the daily charts, you need to look at the monthly. You need top-down analysis to see when a market maker is choosing what to do. Let's put this out here for a second. When a market maker is choosing what to do, you need to be looking at the chart they're looking at. So for instance, this is a monthly chart now. So if I'm analyzing this as a monthly chart, my decisions are going to be a whole lot different from looking at a lower chart. For instance, let's use the Fibonacci again. I would do this, right? So price comes there, right? There you go. That's the 61. You see how it works? These principles work on all charts because price is a fractal. We looked at this in the beginner's mentorship. Price behaves the same way on every time frame. But the key is whatever time frame you're looking at price at determines or drives the decisions you will make. And you want to be making the same decisions as a market maker is making. To do that, you need to be looking at the same charts you're looking at. So there's a 61.8 and then it runs. And then what do we see here? We see market structure break. It's the exact same principles, just on a different time frame. We see a market structure break there. Come on, move that. There we go. So we see a market structure break there. And then price runs up. And so when it runs up, what do? It's changed direction. And you will notice that market structure breaks on higher time frames are very, very significant. It runs up there. There's your Fibonacci. It comes down to the 78.6. It comes down to the 78.6 and then it runs up. And then if we stretch the Fibonacci again, there we go. So on this would be the new low. There we go. We have a 78. So you can see that it's following all the price action principles we've taught you over the last few months. But because you are looking at the same time frame as a market maker is looking at, you're likely to make the same decisions they're making, both in the short term. So they're making their short-term decisions based off the daily, their medium-term decisions based off the weekly, and their long-term decisions based off the monthly. And so if you are looking for short-term movements, use the daily. That's scalping. If you're looking for medium-term movements over a few days, use the weekly. If you're looking for slightly long-term movements for you, say swing trading, use the monthly. And of course, if you are a position trader yourself, then just use the monthly and the weekly, because that's what they're looking at anyway. And so you need to do top-down analysis. Now, the second thing that you will, or you should keep in mind, because market makers are position traders, is this. Price levels are valid for long periods of time. I mean, most people understand the concept of price levels. If you don't understand what price levels are, you shouldn't be trading live. Shut your live account down, get a demo, figure it out. We taught this several times. The fact that price doesn't respect your stochastics, your RSIs, your MACDs, your trend lines. It respects two things: certain times of days of sessions, days, weeks, months, and years, and certain significant price levels. But the mistake some people make is you draw a level in price and you just forget about it because it's been 2 or 3 days. Market makers respect price levels sometimes over years. Let me give you an example. Look at this right here. I'm just going to pick one. Remember, I didn't plan to start with the JAPI. Just picked any chart because it works on all charts. You cannot help but see these things. So let's start from here. Let's draw that level out in time. See that level there? Now, let's look at this candle. So the low of that candle is 101.22. So that price level was quote unquote respected here. You can argue that this didn't get to it. So let's see what the low of this candle is. Come on, MetaTrader. Give me this one. All right, let's zoom that in. Looking for the low of this candle right here. Come on. There we go. So that's 101.65. So we are talking 70 pips. So, yep, 70 pip difference. But, I mean, on a monthly chart, that's nothing. To a market maker, that's nothing. But even if you ignore that one there, it's respected here. Let's point those out to you. And again there. Skip that one. And again there. And again there. And again there. And one more time just for the show, for the road, again there. So we have, let's see, let's add these as well, because I'm going to call that being respected. 70 pips on a monthly chart is absolutely nothing. So that level we see for the first time there. And then we see it 1, 2, 3, 4, 5, 6 times. Now, bear in mind, on a monthly chart, every divider is a year. So every divider on a monthly chart is a year. Remember that. With that being said, let's count the difference or the gap between these touches in years. So this is 1 year. This is 1999. So 2000, so that's 1 year, 2 years, 3 years, 4 years, 5 years. And at the end of the 6th year, beginning of the 7th year, price gets there and respects it. Again, 1 year, 2 years, 3 years, 4 years. In the 5th year after that, it respects it again. So 12 years from the original date. Then again, 1, 2, 3, 4. So that's 16 from the original date. 1, 2, 18 from the original date. 1, 2, 20 years from the original date. 1, 2, 3, 4, 20. So 24 years later, this price level is still significant. Why? Because market makers, because they are position traders, are looking at the long game. Their job is not to make a quick buck from the market. What they're really trying to do is sometimes engineer economic decisions. Sometimes these are the result of countries making agreements to keep their currency value within a certain range to help trading. For instance, this happens. I just picked this currency, but it's interesting. I picked this one. The Japanese yen and the United States dollar. These two countries have a vested interest in keeping their currency within a certain range. It helps them in terms of international trade. Why are these levels important? Because people with deep pockets have orders at that level. In essence, if I draw a zone here, if I draw out a zone there, which is really how these levels work, you should think of them more as zones than just exact price points, although the points can be very precise. Someone with deep pockets sponsored a move here. The next time the move comes back to there, if they haven't finished unwinding their orders, it's going to bounce again. It comes down, once it bounces through it, in essence, that person unwound an order there. Why does supply become resistance become demand and vice versa? We looked at this in the beginner's mentorship session, but let me repeat this here. Remember our entire concept of discount and premium. So let's put up Fibonacci in that range there. So this level here is just beneath the 50. Remember, we said in the price range, anything below 50 is expensive, anything beneath it is cheap. Market makers will buy when price is, they're smart. Remember, we looked at that last time. They'll buy when price is at a discount, they'll sell when it's at a premium. But I also said to you to think of it as a range between the 38.2 and the 61.8. That is quote unquote the fair range. And you notice price spends the most time in that ballpark while it's pinging up and down. This here is in that range. In essence, somebody with deep pockets, or several people with deep pockets, believe that this price point right here is a significant reference point. It's within the fair value zone. And so when price is above it or beneath it, they are using that zone to control this entire price range. This quote unquote they have seen as part of the cost price. If I draw this out, you see that every time price gets in that region there, it seems to consolidate because that is a reference price. You as a retail trader cannot see that on a 30-minute. Look, right now we're in that zone, but you don't know because you're looking at your 30-minute chart, or worse, your 15-minute chart, or even worse, your 5-minute chart, and you're excited. There's a move here. There's a move there. So you're drawing things. Oh, look, there's a market structure break there. And so good. But then do you understand what's driving this on the larger scale? And that market structure break I just drew on a 5-minute chart that looks so exciting, right? That would have made you all of what? Let's see. If you got in here, you put your stop there, or maybe even there, you'd have got what? 40 pips. That's beautiful if you understand the bigger picture of what is happening. Okay, that's the line there. You can barely see it. And so price levels are valid for long periods of time. Now let's drop down to an hour chart. Let's go find that last reaction on the hour chart. Actually, let's use a 4-hour chart. Let's There we go. There it is here. Now, if you're an intra-week trader, you will be looking at a 4-hour chart. When you see this reaction here, this is what we call a gap, a market gap. It means someone was so eager to get down here that they didn't bother to trade price gradually to get there. The price just jumped from there to there. Why? Because there is a pool on liquidity here. Pool, not pool, P-U-L. Let me put that in there. Something you're going to have to think, you're going to have to be, let's see, pool, conscious of when you're dealing with market maker philosophy. We talk about pools on liquidity. In essence, like we said, they have access to information we don't. They can see where orders are resting. They can see the volume of the market at certain levels. This here, because it's a monthly liquidity level. Look, there it is. It's a monthly liquidity level. That level there has been significant for 24 years. If you don't understand that, second, let's find that again. If you don't understand that, you don't have the context of what's going on when you get down there, because the moment price starts to come down this way, if you are an experienced trader, if you know what you're doing, the moment you get into this box, you are not falling for any of this supposed turning point. You know price wants to reach into that level because it's been significant for 24 years. And if it does that and then gives you a market structure break there, you know you can trust it. Right? Because you have the context of what the market maker is doing long term. Not only do you know you can trust it, you know not to get out of this trade too quickly. Look. Now, of course, if you are trading daily or intra-week, that's fine. So you come in, you hold for the week, you get out. Next week, you get back in. You wait for price to come back to this zone here, right? To take out that low. You have a market structure break there, and then you're in again, and then you go. Now, this week, when price does the exact opposite, look at this. When it does the exact opposite on the 4-hour chart, you know to be careful about this short. You can take it if you see a daily engulfing, a 4-hour market structure break, a 4-hour stop hunt, all the rules we use here at IKW. You can take it, but you know to keep on a very short leash. And the moment the next week, see, price doesn't want to come back into here and definitely here, because this is what's controlling it. And as you go, what do you know? It's dancing around in the middle for a little bit. Let's put this, let's put a level out there. It eventually, it actually never makes it back there. And then it starts to run again. And the moment you see it move in that direction you want again, market structure break there, it runs up again. Why? Because it is respecting a market maker level from 24 years ago. All right, I'm going to stop fiddling with that. So let's come back here. Let's get rid of all these lines. So price levels are valid for long periods of time. The third thing that, because market makers are position traders, you want to look for. Actually, no, I've got to duplicate this first. Is seasonal tendencies. Now, I'm really starting to break it down into some very significant concepts here. So I hope you guys are tracking with this. This will save your life. Seasonal tendencies. If you are stuck living on a 15-minute chart, seasonal tendencies mean absolutely nothing to you. On a 15-minute chart, you're looking at daily and weekly tendencies. In fact, on a 15-minute chart, just daily tendencies. What's a daily tendency? We looked at this. This is one of the first things we looked at. That on an up day, let's find, so this is an up day here. On an up day, price is likely to go beneath the open price for the day to find a resistance level or support level and then go up. On a down day, the opposite is likely to happen. Price is likely to go above the daily open price, find resistance. So on an up day, it finds support. On a down day, finds resistance and then shorts. So that's the first tendency. If you don't know this, stop trading. If you don't understand this principle and you are an intraday or intra-week trader, please stop trading right now. Go back to a demo account, look at this, look at all your charts, figure this out. Figure out how to find it, how to see it, what it looks like, how to spot it, and how to apply it. Because this is 101. This is one of the first things we looked at in the mentorship groups and on the course. Also, the fact that significant action is likely to happen, or the significant moves intraday are likely to happen between 6 to 10 a.m. London time. So this here is, so 6 to 10 a.m. London time, that would be 6 a.m. London time would be 8 a.m. on my server, because my server is from Cyprus. So let's find 8 a.m. So from there, 8 a.m. from there, there we go, 8 a.m. to, that'd be 2 p.m. server time, 10 a.m. No, 12 noon server time. So let's find that. So roughly between there and there. Between here and here. And what do you know? That's where that high occurs. It's a daily tendency. Or it will happen between 12 noon and 3 p.m. London time. Those are the 2 time blocks in a day where 70% of all daily moves occur. So that's daily tendencies. If you look at the 4-hour chart, you can see the same concept. That on a down week, let's find a down week here. On a down week, the high of the week is most likely to be formed between Tuesday and Wednesday. And price is likely to run from Tuesday to Thursday or Friday and then reverse. Some weeks it does happen on a Monday, and some weeks it goes all the way to a Friday. But these are some of the tendencies. Also, that when the week starts, you are likely to see, so on a down week, you are likely to see price take out a previous weekly high and then form a market structure break, and the opposite on an up week. These are weekly tendencies, but market makers are looking at what we call seasonal tendencies. And what this means, let's look at a daily chart to show you what a seasonal tendency looks like. So each month on a daily chart is, I'm going to take that color out to make this clearer. Each month on a daily chart, each divide on a daily chart is a month. So this is June, May, April. Let me write this out to show you. Pardon me, but I really need you to see it. So that is June. That we're in now. This is May. I'm just going to type this out real quick. So I'm not going to keep saying what month I'm typing out so I can be quick with it. Just give me a second. Let's do this quickly and then you hear my voice again. So April. Come on. That is March. That would make this February. And this would then be January. And if you wanted to go, but let's go back a couple just to make this point. That would be December. And November. I'm going to do one more. It looks ugly. Call it semi-OCD. I need to correct that. Or right, I'm going to do one more to October, and I'm going to stop there. That should be enough for me to show you what I'm talking about. So let's look at this over the course of a period of time. If this is October, this is September, this is August, this is July, this is June, this is May, this is April. You get the point. You will notice something very interesting here. I'm just looking at this chart to see if I can see it. Again, these rules aren't always, they're not 100% of the time, but they follow. I want to show you something. Let's ignore what started happening in February, because obviously this is the coronavirus situation. The spike down and then up in the coronavirus. So notice how even the coronavirus respected a 24-year-old level. I forgot to mention that even the worst economic crash in a decade still respected that level there. So let's ignore that, because that's why that's misbehaving. Let's look at the rest of this chart. I'm going to draw the highs and lows as we go along. Just show you this real quick. So let's start from there. Price goes up, right? Up until there. Then it comes down in that zone there. I'm going to change that color. So let's call the downs red. Not orange, red. Let's call them red. And let's call the ups green. Does that make sense? There we go. So just watch this. So there's another up there. And there's another down there. No, not you. There's another down there. Let's see. Let's put the down here. Actually, the down is from here. So the up is there. And I want you to pictorially repeat this across the rest of the chart. Notice something. This starts when? In April 2018. So April, May, June. 3 months. Then there's a down in July and August. Then another up that spans 1, 2, 3 months. And then another down that spans just about 2 months. And you will notice on average, roughly in an uptrend, you're seeing a 3-month rally and roughly a 2-month retracement. And it flips the other way. Again, they're not exact in their lengths of time, but you can see a pattern. Even after establishing a directional bias, there is a seasonal pattern. We call it seasonal tendencies. Secondly, at certain points in the year, I don't have the time to go into this today, you will notice that certain currencies do certain things. They rally into the summer, they retrace during the fall. They form a high during the spring and a bottom during the winter. Different currencies have different seasonal tendencies. I don't have the time to go into all of them. But these repeat between 60 to 80% year in, year out, in spite of issues like coronavirus crashes or Brexit or credit bubble crashes and things of that nature. And these are the things that the market makers are looking at. They're not looking at your 15-minute market structure break. And so if you realize that on a daily chart here, you are in an uptrend. Let's get rid of that. Let's give an example. You draw a line here. You realize that you're in an uptrend because of that level of market structure break on a daily chart. So when it breaks that level, it forms that low there. So let's see what's the up move there. It starts here, right? And it goes to here. You could argue it started down there or even down there. So let's take that entire one, but you caught it here. Because you understand how market makers work, they have large price objectives, they have seasonal tendencies, right? All the stuff we looked at here. Also, they respect price levels for long periods of time. Why would you get out of this trade here? Let's just draw a line here. Let's draw a line there. So you got in here. Let's assume you got in here. And then this happens. Why would you want to get out here? Now let's look at that on a lower time frame to show you what I mean. Let's drop to a 1 hour time frame. Let's go find those zones in a 1 hour time frame. Second. Okay, let's go back to daily. We're looking at February 2018. Okay, we need to look at a far chart to get that far. February 2018. Why can't I find this level? 1 second. So this is 19. We go back. 2018. Okay, so 2018. Why are we jumping? I have no clue what my charts are doing. Let's find this again. So that's 2018. So it's on a daily chart. Anyway, for the sake of time, I'm just going to ignore that. My point is, I can bet you that I will find some reason on a 15-minute chart to want to close this trade in this section here. But I understand there is a seasonal tendency going on. Once this move begins, I am willing to bet it is going to last at least 60 days. Write that down, 60 days. I'm not going to go into any further for today. I'm willing to bet it's going to last roughly in the region of 60 days. If this is going to be going on for 60 days, I then have a directional bias for 60 days. For these, let's see if I can just find this one more time on a lower time frame. For these next 60 days, I have no business doing anything other than buying on my chart. I do not care about all the sell signals. I'm moving in one direction. I am buying. I'm looking for every excuse to buy. I think we might find it now. There we go. We're almost there. This chart, anyway, I'm just going to give up on this. I think this chart is jumping sections for some reason, which I have no clue about. Anyway, I'm looking for reasons to buy because I know price is in a seasonal move. Because a market maker is sponsoring this move. A market maker is sponsoring this move. The footprints are there. It is going to be seasonal. Roughly after 60 days, what happens? There is a retracement. Retracement lasts how many days does this one last? This is a short one. That lasts only 4 or 5 days. Fine. It goes up again. Now, this is a more significant retracement. This one lasts 23 days. And then it goes up again. And so understanding these seasonal tendencies, pairing times of the year, times of the month with your expectation for market maker sponsored moves gives you both a bias and a length of time to be in the macro trade. So even if you're breaking it up into days and weeks here and there, you still have a long-term picture of what the price is doing in the bigger picture that you can rally around. There's 2 more I want to give you today before I close. The 4th one is this. Again, these are all coming from the fact that they're position traders. Next time I'm going to talk about other market maker behavior based on other market maker properties. But for today, we're dealing with them being position traders. Because they're position traders, and I think I said this at the beginning, but I didn't write it down. They have no business in a 40, 50, or 100 pip move. They need / want huge pip moves or huge pip objectives. If you see a move that lasted only 100, 200 pips, it might not have been sponsored by a market maker. When they get in the market for real, they're looking 1,000 pips overall. It could take a month, 2 months, or more. And so when you have caught a tiger by the tail, as a mentor of mine used to say, don't let it go till it shakes everything it has to give. And so again, if you look at a monthly chart for this, let's look at this moves here. So price picks up here, and on the monthly chart, it keeps moving 8 straight months for a grand total of 2,000 pips. That's a market maker move. There's a retracement, and then it goes again. So in essence, this consolidation here is not the market maker giving up on that move. It's them repricing orders. So what's going on there and there? When they're ready to turn price for real, again, over 13 months, they move it again another 2,700 pips. So you can see the point here. And so when you are, now, there are times when they're not really driving it that much. They're holding price in a range, and that's where you scalp. But when you are in a trend formed by a market maker, bear in mind it's likely to last a significant amount of time, meaning you can increase your profit objectives, but you also need to be careful about taking so-called reversals because the long-term trend is in that direction. I already explained that at the beginning, just wanted to make that clear. Now, where were we? Number 5, which is as a result of that, they tend to sponsor long-lasting moves. So we looked at that already. Moves that last months at least. And even the retracements and expansion legs last months at a go as well. Well, what have I just done? Okay, 1 second. I'm going to have to replace that. So let's see if I can remember exactly how I worded that. Let's put it this way. They go for large pip objectives. Let's call them huge pip objectives. And the last one I'm going to look at today is this. Let's put that there. Is this. Their moves or their actions cause significant momentum / displacement. And I left this for last because it's perhaps the most important sign of a market maker move. Now, bear in mind, top-down analysis because they're position traders, meaning you're only going to see them really work on the higher time frames. Price levels are valid for long periods of time. They have seasonal tendencies. They go for huge pip objectives. They tend to sponsor long-lasting moves. And their actions cause significant momentum displacement. Now, let's drop down to a 4-hour chart because this is the crossover between a market maker and a retail trader. The 4-hour chart is the one, well, the 4-hour and the daily chart are the two time frames where both sets of traders live. Let's look at the 4-hour chart to really see this. I want you to look at the pip ranges on this chart right here. And I want you to see, actually that's a bit too, yeah. The times where in one candle, maximum 2, price traveled a significant distance. Let's take these off for now. So let's start from here. Remember, we're looking for telltale signs, right? Stop hunts, market structure breaks. But how do you know which of them were sponsored by market makers? I'm glad you asked. So here we have a stop hunt. Now, notice it takes almost an entire week. So from the end of one week to the middle of the next for this move to really get going. But I want you to see what happens every time price visits that level. 200 pips, then he comes back. 174, then he comes back. 130, then it comes back. 60, it comes back a final time, and then it runs. And when it finally runs, it runs to the tune of 450 pips. I want you to compare that with this one down here. Again, this is for an obvious 4-hour high being stop rated. Let's look at the rejections. First of all, from the high there to there, 64, 85, 82, and then it runs eventually. Well, how much does it run for? Only 240. And you can see this move doesn't have anywhere near the same momentum as this one. Why? All you're doing is looking at that on a 4-hour chart. So let's draw this line here on a 4-hour chart. And let's look at this line on a weekly chart. There's the line there. That's this one here on a weekly chart. If you can see this level here on a 4-hour chart is price returning to a weekly liquidity profile. In this case, an order block. I'll just leave that in green for the sake of. Now let's go back and look at that again in the 4-hour chart. One second. That's the line there. Do you see it now? There is no significant weekly or market maker sponsorship there. That's just being controlled as part of this overall move. This is an engineered intra-move liquidity run to try and get this further down before it keeps on moving. This is the real business here. And as you can see, even if you did not know what was going on, when you see this happen, when price rejects from a level multiple times with momentum on a lower time frame, huge. Now let's look at the candle sizes here. So this candle traveled 98 pips in a 4-hour candle. This one here traveled, same candle, 93 pips. This one here traveled, again, 98 pips. Compare that with these ones here. That's 48, 39. You get the point. Don't overcomplicate it is the point I'm trying to make. Let's look at the other side here. Of course, we know this was a 24-year level. Look at 4-hour candles. Look at this. 132 pips. This one here. One candle. 165 pips. These are, of course, we know what's going on at that level. If we zoom out, we pulled that there already. Let's go to a monthly chart. See that level there, the pull on liquidity. It's from 24 years ago, respected 5 or 6 times. In essence, like I said to you 2 sessions ago, when an elephant runs through your garden, it will usually leave huge footprints. It cannot tiptoe through your garden without letting you know it was there. Don't get it twisted. Don't overcomplicate it. Just look for huge, significant, obvious displacements in price. Think of it as an elephant jumping in your bathtub. It's going to, when this elephant jumps in here, it's going to have a huge displacement. Because this was an elephant that jumped in here. This is how I want you to think about it. An elephant jumped in. It's going to have a huge displacement coming out. An elephant jumped in there. It's going to have a huge displacement coming out. If a dog jumped in, it's going to have a small displacement coming out. You are looking for momentum and displacement at significant levels based on higher time frame zones, because that's what the market makers are looking at. And when you see them on lower time frames, those become your controlling levels. So for instance, we had a market maker here. Let me take this off to make this. We know we had a market maker move here, sponsored move here. And then we then know that there's another one at this level. Of course, it started at this level over there, but then it returned there. And because that zone is a market maker zone. We now know there was a market maker, there was a market maker. And when they returned there, they formed that, they returned there and rejected from that sharply. So at that point, I can literally move my Fibonacci down there, because they have now told me that they're willing to defend that level just as hard as that one up there. I know price is going to be kept in this range for a significant amount of time. When I am plotting on my lower time frame, that's the Fibonacci I want to have drawn out. This is telling me what's expensive and what's cheap. Why? These 2 price points are market maker sponsored moves. Everything else in between is a reference. And notice we're still there, 10th of March, we're still there in June. Because an elephant jumped in there, an elephant jumped in here. So what do? First of all, where's 50? That's 50. When we're beneath 50, what are we looking to do? To buy. Price dips beneath there and starts to hold in a consolidation. Also, what do? We draw out our cost price zone there in the middle. Once price makes a significant jump to this side here and reacts on a 4-hour with confidence, we are shorting. Why? Because we know we're still in this 2 market maker defined levels, or the zone defined by this 2 market maker levels. And so anything up here should be a sell until it comes back down into this middle zone. To help you with this, I'm going to put another, because usually I would just flip my Fibonacci depending on what direction I'm going in. But I'm going to add another price level. So we're going to call it the, one quick second, sorry. Right, so I'm going to call this 0.214. 0.214. And I'm going to call this the 21.4 level. So there we go. I am also actually, let's see. I am going to actually, no, I can't do that on this software. I cannot do that on this software. I can't give the different levels, different colors. Okay, that's fine. That's fine. That's on. Cool. So keep your eye on 21.4 and 78.6. In this zone, I'm looking for shorts around 78.6. It'll be anywhere between 61.8 up to there. And I'm looking for longs anywhere between 38.6 to 21.4. Because I know this 2 price points have market maker influence in them. This then controls a zone. And so over this period of time, let's drop down to a 1-hour chart. We know what we're doing. So let's go back to the start to see how these quote unquote magic signals we supposedly give work. Well, here we're at the top of the range here. So of course that's the move. There's a market structure break there. It goes down there. Bear in mind, it comes back up here to between the 60. This is 61.8. That's 78.6, right? So it forms there. What do we have there? We have a market structure break. And so we can take it with confidence, even though it takes a few days to get going. Why? Because we understand where the market makers have done their business. And so we come down. The moment we come down back into the fair cost price value range, in essence, this is the equilibrium level of price in this box here. We see a market structure break, right? So we might get out here because we're now in this fair region. However, we expect it to get down to 50. The moment it gets down to 50, we start to look again. Now, in this region here, we are very careful because we're not too sure what price wants to do. The moment it comes back out of that box, of that 61.8 level, right, and forms a market structure break again there, what do? We're in. Comes back down into equilibrium again, forms back out. Now it really comes out here, takes out that level, and forms another market structure break there. So what do we do again? We're in the buy zone. or sell zone, sorry. So we sell. That, well, gives you a little bit. Now this comes up here again, and now we're at 78.6. We know we are so far at a premium that the market maker between those two levels they just created are going to want to correct price back down to the medium price. And so when this happens here, we expect a significant run. Notice how price doesn't hang around there. Why? Because it's too expensive. Supply and demand is working to bring it down back. This green level here is the equilibrium level there between 61.8 and 38.2 to bring it back down this way. And notice how significant that move is. First, 327 pips, and then eventually 378 pips in total. And of course, once it gets back down to 50, what does it do? It starts to dance around again. If you don't understand what happened, if you don't understand how this was formed, we see two heavy displacement moves by market maker at higher level time frame zones or levels. We don't care even if we missed these moves. Why? We know now that these two price points have been established, we will get loads of other trades in between before price leaves this zone, except we see on a higher time frame that there is a drawn liquidity to a level beneath or above the zone. More on that later. And how do we know this? Simple. Because their actions cause significant momentum or displacement. When you see significant momentum or displacement, you know a market maker has done business there. Whether you're trending in a consolidation or reversing, you can make your decisions based on those actions. And of course, go to the beginners to the mentorship section where we spoke about market profiles. So we looked at things like the reversal profile, the consolidation profile, and the trending profile. I'm going to leave it there today so it doesn't get too heavy. Please go over this video several times, or at least a couple of times. You may not have got the whole picture the first time. I know it's been a bit heavy on information, but these are the foundations we need to lay to begin to understand the principles of how we trade before we start tagging off on levels and patterns and liquidity profiles and order blocks and market structure breaks and things of that nature. This has been Israel. We'll be back tomorrow evening, Sunday evening, 9:30 in the evening, to do our pre-week analysis session. I'm going to see if I can get Talkway along, but even if he's not here, one of us will do it tomorrow to prepare for the week ahead and see what we're looking for in price. Take care. All the best. Enjoy your trading. This has been Israel from Israel Keys Wealth.